All right, guys, just a short lesson today since it's Friday. I'm just going to briefly look at leasing. Leasing is one of the key things that many businesses do to reduce their capital outlays, i.e. spending vast amounts of money buying things. Leasing is kind of similar to how renting works, but eventually you purchase the item outright. There are a couple of advantages of that. So basically the leasing company, a third-party company, will purchase the assets on behalf of the business and then basically charges them a monthly payment to repay the asset. It means you get the asset up front, but you're only paying that monthly charge rather than the capital cost. For example, a $60,000 car, you're paying maybe $1,000 a month rather than $60,000 up front plus all the ongoing running costs. It's a very common source of financing in Australia, mainly because there are very good tax advantages to be used from gaining the leases. So on a financial lease, every payment you make on that lease is fully tax deductible, whereas if you are purchasing the asset outright, you can depreciate it using the tax system, but only at 40% per year. So that $60,000 car, basically 40% in the first year, you can basically take a $24,000 tax offset on that, but then it's only worth 26,000, so 36,000 the next year, and you take 40% of that, and so on until after about 5 years. It's no advantage to actually depreciating it anymore. Whereas the leasing is always 100% tax deductible. There are two types of leases. Basically, an operating lease is a short-term one, shorter than the lifespan, and it's typically for things like construction companies who are going to use a crane for 12 months. They don't want to buy the crane, and they might lease it for a certain time. It costs more to do that, but you don't actually have to purchase the thing at the end of it. So it's more expensive. But again, you're not actually buying the equipment at the end. But the most common type is the financial lease. And it's typically for the life of the asset. So when we talk about the life of the asset, it's not the useful life, it's the financial life. So until how long it can't be depreciated anymore. So it's typically 5 years. A car lease is certainly set up for 5 years. Things like computers tend to be even shorter, maybe 2 to 3 years for those. The rate that computers have improved traditionally using Moore's law, they're outdated after 2 years, so most businesses turn them over. So rather than buy them and then have to get rid of them when they're effectively worthless, they lease them and then basically give them back to the leasing company and get new ones and just keep paying that monthly fee. There are lower costs of establishing a lease. It doesn't require the capital outlay, it's just an upfront payment. And it provides that long-term financing. So it's not debt financing, but it's long-term financing without losing any control of your company. You're not selling any part of your company. You're gaining maintaining full control of it. And the repayments are fixed, so you know you can forecast, say for the 5 years, of exactly how much you're going to have to pay, and then you'll know in advance for cash flow purposes how much you're going to need. And as I say, it's 100% tax deductible. So most large companies in Australia will lease their equipment. They may decide they want to keep it, and at the end of the lease, they basically there's always a residual amount owing at the end of the lease. It's typically 15%, so they decide either they can sell the item, or the finance company will sell on their behalf, and then take that 15% out and return whatever is left over to the person who leased it, and then they can start a new lease, or they might decide to pay that residual and own the goods outright. For example, my last car, at the end of the lease, basically after it was sold, there was and the residual was paid out, I had like an $8,000 payment. All of a sudden, that's extra cash. Get a new lease for a new car, take that $8,000 and use it for whatever you like. It's basically after tax as well. So there's really good advantages for doing that. So that's basically leasing. You need to know what they are, what it's used for, and the advantages are that it's reducing your capital costs and it's allowing you to improve cash flow, particularly when you're starting out in the business. Leasing is one of the key ways to go. Because you don't have to have that huge outlay to start up, and basically, if you go bankrupt, you're not liable for the cost of these assets. They're owned by the leasing company. All right, that's it.